Hi, everyone. Welcome to Smarter Lending, the essential podcast for environmental, construction, and appraisal due diligence insights. My name is Liz Mahoney. As your host and the Director of Sales and Business Development at Lender Consulting Services, I bring 15 years of national lending expertise to the table. Join us as we engage with industry experts to demystify due diligence, reveal insider knowledge, and stay ahead of the trends. Whether you're in the trenches or new to the field, tune in for Smarter Lending Strategies. Let's dive in. Welcome to another episode of the Smarter Lending Podcast. Today, we have an exciting and highly relevant topic for our listeners in the banking and lending community: navigating distressed properties, insights for banks and lenders. As we navigate through challenging economic times, understanding the intricacies of distressed properties is crucial for lenders, appraisers, and everyone involved in the commercial real estate market. Our episode today features two distinguished panelists who bring a wealth of experience and insight into the discussion. First, we have Aaron Fehnel, Vice President and WNY Market Loan Workout Manager at Tompkins Community Bank. Aaron has over 20 years of experience in banking, including credit analysis, loan workout, and loan asset quality reporting. Aaron's current role involves overseeing the criticized loan portfolio for Tompkins in the Western New York market. Before joining Tompkins, Aaron managed a special assets group at Genesee Regional Bank, where he handled loan portfolio, asset quality reporting, and appraisal and environmental review processes. Aaron is also the president-elect of the Upstate New York Turnaround Management Association chapter and a former board member of the Empire chapter of the Risk Management Association. Aaron's extensive background in distressed commercial loans makes him an invaluable resource for our discussion today. And joining Aaron is our very own Noelle McDonald, Vice President, Valuation Services at Lender Consulting Services. Noelle brings over 25 years of expertise in the commercial real estate industry. She's a certified general appraiser with active licenses in several states. Her experience spans complex valuation and consulting assignments for acquisition, disposition, litigation, estate settlement, and portfolio management. Noelle has also served as an appraisal reviewer for a national bank and as an underwriter for HUD. Her leadership in business development and strategic planning has been instrumental in driving high-quality client services and company growth. Noelle's deep understanding of valuation and appraisal processes provides a critical perspective on distressed properties. In today's episode, we'll be diving into several key areas, including the current state of the distressed property market and its implications for lenders, best practices for managing distressed loan portfolios, the role of appraisals and valuations in distressed property scenarios, successful strategies and common pitfalls in handling distressed properties, and real-world examples and case studies from our panelists' extensive experience. Whether you're a lender looking to navigate the complexities of distressed properties or an appraiser aiming to provide accurate valuations in challenging conditions, this episode is packed with valuable insight and practical advice. So, grab your notebook and get ready to learn from the best in the industry. Let's get started with navigating distressed properties, insights for banks and lenders. Thank you both for joining us. Let's dive right in. Noelle, let's kick things off with you. In the world of foreclosure sale auctions, or when a lender holds a property and markets it for sale, how accurate are property valuations really? Is it more of an art or a science?
That's really a great question, Liz. I mean, essentially, an appraisal is a value opinion, right? Operative word being opinion. It's based off of the available market data at the time. So when you're talking about opinion, the accuracy can always be challenged. There is that science involved with the data that should be prevalent. The appraiser should be able to interpret that, by applying a lens of the market, but it's really the accuracy of the data. With distressed sales, often there's, public auctions with buyers having various different types of motivations. And it makes the process a little bit more complex for an appraiser because there, you have to kind of get in the mindset of the buyers and the sellers. The most accurate appraisals, they'll come with the best available data, particularly, we want to use comparable sales that have closed quickly, under the same kind of distress conditions when we're looking at valuing a property that is in distress. An appraiser really needs to know and have experience assessing the current market conditions, including, how many other properties are competing out there for sale and what are the exposure trends of those properties and how they differ from distressed properties, where is that quick sale that goes on in order for the valuation or the appraisal to really be accurate. My suggestion is always to work with experienced appraisers because they have more, time in the market and they know what goes on with these different market fluctuations. You've been through a couple of market cycles, but that's really crucial to get an accurate appraisal product in that sense.
Thanks. That makes a lot of sense, Noelle. Aaron, turning to you now, loan sales as a way for lenders to exit loans prior to foreclosure seem like a smart move. How have these sales performed this year? Are lenders seeing success with this strategy?
Yeah, it's really in certain segments a good time this year. A lot of sellers are seeing prices in the 80s of par on their non-performing loan sales. Many bidders out there. There's been reduced inventory in the secondary market, origination market, but there's still a lot of money out there. So they've been a place that's they're still been keeping prices high with loan sales. There are specifically the multifamily properties are still remaining attractive. Certainly there's pockets that are tougher and getting well below that. Once you start getting into the BC office space, between the high vacancies, the capital costs of carrying, those are tougher and more of a discount. Along with we're seeing some stress too in different segments of healthcare as well. But larger lenders, we've seen selling off larger pools of small business loans that are non-performing, with the thought that they're making capacity with their workout teams for lower larger balance loans that are out there.
Noelle, back to you. What are the key factors that really drive down the value of distressed commercial properties? Is there a common theme that you're seeing?
Well, just like Aaron kind of just touched on, distressed properties typically suffer from a decline in rental income. There's a decline in the cash flow. Usually there's higher than normal vacancies. You have tenants that have exited early in some cases or, problems with releasing. So this translates to significant declines in the NOI, the net operating income, or the bottom line that, we need to kind of cover the debt service on the loan. So obviously, anytime you have that big drop off in income and you've got a lot of vacancy, these factors kind of translate, to higher risk and in a lower property value. It really does heavily impact the value of the property overall.
So, Aaron, let's talk about regulations. Do you anticipate any significant changes in foreclosure laws or regulations that might impact commercial property owners? Is there anything on the horizon that might shake things up a little bit?
Yeah, like Liz, that's a great question. As some states are adopting what's called a uniform receivership. This is granting broader powers than a typical receiver. For instance, in New York State, a uniform receiver can sell a property free of a lien, so it avoids having to go through the entire foreclosure process or a bankruptcy process, and then the cost to go along typically with a bankruptcy and delays. It can really speed things up. We don't really see it from folks I've talked to being adopted in New York State, but it's definitely something that's out there that really helps lenders get through the process quicker. Typically, the longer these go on for a lender, the worse it is. So if you can exit quicker and get to a sale, the better for the lender and quite frankly, better for the borrower often too.
Any reason New York's holding back that you're aware of from?
It's just more that I think the overall New York tends to be more debtor friendly and wants to give borrowers in New York more time to work out and work through processes. You'll see it on both the commercial and on the residential side, where there's more required mediations and settlement talks to really go through it versus going through where a lender goes through to a sale. It's really more on what we often see and has been for quite a long time is more of a debtor friendly system.
Noelle, how does the condition of a property typically deteriorate before it enters foreclosure? What are some of the signs that a property is heading towards distress?
Yeah, I mean, a decline in cash flow usually is a big signal, and it translates to a lack of funds to kind of upkeep the building. What you would normally do if the asset was performing well. It tends to lead to a lot of deferred maintenance of the big, critical components of the real estate. When you think about the roof, repairs to the roof or HVAC systems, plumbing, parking areas with the paving, the landscaping, you'll see, it hasn't been touched. All of these things that kind of, from the outside, from inspections, we can go out there and see that there's some trouble, that's kind of where you see a lot of the funds, there's evidence there. And you talk to maybe the maintenance schedule, the maintenance guy on schedule during that inspection. We have ways to kind of get at the physical condition of the properties, but they tend to suffer a little bit when you talk about that upkeep. And that's kind of where we get the clues on how distressed or how bad it might really be.
So, Aaron, local government policies can be a wild card in all this. What role do they play in the rehabilitation of distressed properties? Are they helpful or are they more of a hindrance?
So we've seen local governments typically through code enforcement being more aggressive at demanding repairs beyond typical maintenance. We've seen, and then pushing the lender to cover the costs or add it to the loan balance. Such things as driveways and things like that, which years ago we wouldn't really see as much. It would be more like securing the property, or if it's on the residential side, just appearance, lawn mowing, things like that. But it seems to have expanded, and we're seeing it in the commercial area too. To properties where maybe the parking lot needed a top coat, and just different levels of kind of push from local municipalities to keep the properties, bigger ticket items for the lenders, the bear than just general maintenance for the most part. And overall, it's been really more often on the residential side, but it's definitely grown and expanded more to commercial properties as well.
Noelle, eviction moratoriums have been a hot topic. How do they affect the foreclosure process for commercial properties? Do you think it's a game changer?
I mean, eviction moratoriums, you consider each state has their own set of laws around the foreclosure process. These type of things definitely significantly impact, the quickness or the pace of distressed property sales. Sometimes it takes a lot for that foreclosure to go through. There's a lot of red tape. You have states like Texas or Montana where it's reported that they have some of the more rapid foreclosure processes, or versus states like Louisiana or New York and Nevada, is one of them as well, that they can have lengthy processes lasting up to 12 months or sometimes even more. These things can go out for years, especially on the commercial property side. So it definitely impacts, the market overall on how fast you can move on that asset that's in trouble.
So, Aaron, what are the key regulatory challenges facing lenders in managing distressed properties? Are there any particular hurdles that stand out to you?
Yeah, there have been. I mean, since the pandemic, obtaining the actual foreclosure judgment and then scheduling the sales has definitely become more of a challenge. The courts are more involved with the micromanagement, and then there's in some courts significant backlogs because of the pandemic moratoriums that were out there. So getting through that process and just getting through the workflow, there's certain areas where bankruptcy proceeding is often favored by a lender because the quicker alternative to exit property through a sale versus a traditional foreclosure process, which it's one of the first times I've seen that occur.
So, Noelle, managing a portfolio with distressed properties sounds like juggling flaming swords. What are the best practices for keeping everything under control? I know you like to throw those swords around, but
Well, I did watch House of Dragons last night. I had to catch up. But yeah, I mean, the biggest thing is the more information, the more, how do you have your finger on the pulse? I would say more accurate and frequent assessment of the property's cash flow is super essential. You've got to really know how much money is actually coming into that property and know how much is coming out. This includes kind of monitoring when lease expirations are coming up. What is the releasing looking like? Do you have some turnover that will be expected in the near term? The payment histories of the tenants, are we working with tenants that have, late fees all the time? Or do we have a kind of strong, steady cash flow for some and not all? The rental rates in the market, what is market? Are you below or above the market? There's some risk that's involved with being above market on some leases because there's always that chance that a tenant could default and move somewhere a little bit cheaper. Or you might be in a renegotiation wrestling match or sword duel before you look up. A lot of times, the real estate taxes may decline or be eligible for reduction due to a decreased vacancies. That's something that you want to be on top of when you're thinking about ways to kind of restructure that cash flow, so that you're a little bit better off. Insurance expenses tend to fluctuate with vacancy as well. You might have to pay a little bit more if you've got a lot of vacant space. There's a tendency for a little bit more, maybe vandalism, as the insurance companies have identified. I think it's key that you retain some active leasing agents in those markets. If you've got a distressed property in your portfolio, stay in touch with the people on the boots on the ground. They know first off how active that market is, and you want to be in touch with those folks to feel like what's really going on with your asset. And order an appraisal, order a quick eval, get somebody with a third party eye on that asset to really give you a good education or indication of where you are with value on that asset.
Thanks, Noelle. And last but not least, which strategies are investors using to finance the purchase of distressed properties? With the market being tight, how are they making these deals happen?
And that's really been a shift with the tighter credit markets over this past year. We're seeing many more transactions that are initially done with cash or privately funded pools, investment funds, and then with the plan being that when the property stabilizes, that a bank would come in and take them out, and that's across. When I talk to many of my peers at other banks and other partners through the Turnaround Management Association, that seems to be at least throughout the Northeast pretty common when you talk to auctioneers. Like what are they seeing for properties? It's really cash or privately funded is really is creeping up incrementally over the past year because the banks currently just they don't have an appetite as they once did currently.
Yeah, it makes a lot of sense, Aaron. I've been to a lot of conferences lately, throughout the country in the private money space, and then also Craft C recently in New York. And everything you just said is exactly the sentiment that's being expressed on the panels. So thank you, Noelle and Aaron, for sharing your insights on distressed properties today. The discussion's been incredibly informative for our listeners. If you have any questions or topics you'd like us to cover in the future episodes, please reach out. Until next time, this is Liz Mahoney reminding you to stay smart in your lending practices. Thank you for tuning in to the Smarter Lending Podcast.